In this recording, we're going to look at the Autumn 2019 Question 1, Tempa Limited. Again, what we're focusing on these screencasts now is your approach to the question, not just the solution. So first thing you'll always do, and often this will be the first question you'll do in the paper, look at the requirements. So this question is actually asking you for three statements: statement of profit and loss, statement of financial position, and they're always going to be asked. The question is then, am I asked for a statement of change in equity or not? And you are in this case. You have three statements and have them in the back of your mind. In terms of if you identify anything you think might go to statement of change in equity, you label it as you go. And you note the marks because that will be for your timing. Usually it'll be around 30 to 35 marks. But here, for example, if you're thinking your timing, you have 180 minutes, roughly, and 35% of that. So about an hour, give or take an hour to do this question. So think in the back of your mind your timing as well. The first thing you should do when you go down through the question is just have a quick look and mark it up as you go along, in case you see anything unusual. So you'll see you'll be given notes that reference certain items. But just to go down along, is there anything unusual? That's opening inventory. So you'll know that goes to cost of sales. You'll notice here the dates and accumulated depreciation. They are from last year, because this is the year end 2018. So that means you haven't charged depreciation yet. And that will link to note 3 and note 2. Government grant, there's a note there, it might be an adjustment. Dividends, you might flag that and straight away you'll write there statement of changes in equity, because you know that's where the dividend goes. And then a lot of these things seem to be quite generic as you go down along. And remember, the retained earnings in your trial balance will always be the opening balance. That's the closing at the end of last year, at the end of 2017. So I'd always look down, do I see anything that's unusual, likes of dividends, the likes of, you might have a suspense account, there might be a line item to do with a disposal, and you'll know straight away there's something wrong there that you're going to have to update it based on the notes. So once you've kind of marked up your trial balance, have a look through the notes, and always look through all of the notes first and just jot down, right, what's the standard and is there any links anywhere else in the question. So it's always a good practice just to have a quick look through all the ones first, because you might come across a hard one and you think, right, I'll skip that and I'll come back to it at the end. You don't have to do them in order as long as you clearly label them and you do them all at some stage in the question. So closing inventory at the year end was 35. We know straight away you should be saying that's an IAS 2. And we'll figure out then how do we bring in closing inventory into the trial balance. Right, but just get the discipline. We're then told about a property, which we know straight away should be IAS 16. You're told cost model, depreciation. And then you're told about the recoverable amount and no adjustments has been made. So when you see a recoverable amount, another standard should be coming into your head, IAS 36. So there's two standards at play there. But as I'm reading down through it, I'll be just jotting down those. It's an IAS 16 issue combined with an IAS 36. And you can come back to it again. You might want to do that first, or you might want to leave it till the end. Then we're looking at intangible assets, which we know is IAS 38. Bought them in 2017, so 2 years ago now. Useful life of 5 years, but an accounting error, no amortization was applied last year, and the error is material. So you should have in the back of your head that is actually IAS 8. Now we cover that later in semester, but we're just trying to bring in other areas. That's a prior period error, so under IAS 8. And again, intangible assets IAS 38, which we're going to cover relatively soon in semester 2 as well. So we have IAS 38 there and IAS 8. 1st of January this year, they received a government grant. Straight away, you know IAS 20. Was meant to compensate for hiring interns over 4 years. And what they've done is debited cash, credited government grant. And we've seen that's the government grant up here for 80. We know that's not right because it should be over 4 years. So we're going to have to expense that or amortize it over the 4 years as well. So you'll flag that in IAS 20 issue. Then you have note 5. It's just a normal bad debt and provision for bad debt. Quite straightforward there. Your tax expense is given to you. You don't have to do working for it. But unusually here, the tax liability, if you flag it, it's actually an asset. So it's on the debit side. So did you notice that in your trial balance? And they tell you here it's because they've overpaid. So that looks to be fine. They've made an error, obviously paid more, put on a 0 or something. And that overpayment would have been to credit your bank when you paid it, but to debit a tax asset because you're actually owed that money back. So that tax 6,000 will be a current asset, not a current liability. And finally, then interest of 10% of the loan liability has yet to be accrued. And that's going to be payable in June 2021. Again, why are you told that? Because that'll be about the classification. So it's going to be a non-current liability. So that only might take 1 or 2 minutes, but it's just good discipline to write down the standard IS2, IS16, IS36, and also have a general idea now where are the harder ones, because you might leave some of the harder ones till the end, so you won't lose a lot of time, and get the easier adjustments at the start to build a bit of confidence and to get some marks on the board. My suggested approach then for the solution is to put your financial statements first. Some students want to do the template out, and they might write it out like that, because the template is very similar year on, question on question. You might just leave a couple of lines in case there's any new items, but you might leave 1 page for the P&L, 2 pages for the financial position, and a page then if you have the statement of change in equity or not. As I said, some students will leave that at the end, but I think it's nice to leave your financial statements at the start of your exam booklet. And once you're 4 pages in, then you start your workings. Reference working 1. And the nice thing about that is you don't care then how long your workings are, because you have space left for your financial statements. And as you finish with something, you might want to slot it in. So as you start thinking about your approach, that's what these screencasts are for as well, of how you can be efficient. You don't want to be doubling back on workings time and time again. So what I'm going to do is I'm going to go through all the workings here, working 1 down long. And as we finish with something, we'll try and slot it in to show you that's a useful approach and it'll be very efficient in terms of time. And we'll give you an idea of the key pitfalls students might make. All right, so we start with working 1. The cost of closing inventory at the year end was 35,000. Now, I get the discipline because there will be marks going for it. Just right there, that's IS2. To show the examiner that I know inventory is covered in IS2. Now, you don't have to give the debits and credits, right? They're not required unless they're asked for. This is just for tutorial purposes. So you're going to debit here inventory, current asset, and you're going to credit cost of sales. And that's going to be 35,000. So debit inventory, and I'll just put actually 35. So we'll drop the last 3 zeros. So you're crediting cost of sales, which is reducing cost of sales, and you're putting inventory in current assets, the closing inventory. And that's as simple as the adjustment is. If you're a good student then and you want to slot them in as you went, I have my statement of financial position set up, and I'll put inventory working 1 and just slot in 35. So I'm actually finished with that inventory. I have to wait then and do my cost of sales at the very end. But you can slot in certain things, and you'll get that at the more you go through questions. You can finish them as you go. So we then move on to working 2, which we've already flagged is IS16 and IS36. So again, IS16, IS36, just to flag to the examiner, we know what's going on. So in this case here, we're told, watch your key dates, highlight them. On the 1st of January 16, which is 3 years ago, all 16, all 17, all 18. They acquired a property. Accounting policy was 50 years from the acquisition date, no residual value, and depreciation for this year, like we've said already, has not been charged. Then at the 31st December, at the year end, the director's accrued recoverable amount has decreased to A'20 and the reduced useful life of 40 years. So what we're looking at here then is the initial cost, if we look on the trial balance, was 1 million. So again, we're dropping the last 3 zeros. Your accumulated depreciation, which would have been for 16, 17, and 18, 3 years, and you're told it was 50-year life. So it's going to be 1,000 or a million divided by 50 times 3. So your net book value at the 31st to the 12th, 18, is 940,000. Now remember, we haven't charged depreciation for this year already, and you're told depreciation, or all charges, are split between cost of sales, admin, and selling expenses, which is other word for distribution expenses, selling and distribution costs. So we might split it here. You're going to debit cost of sales, debit admin expenses, and debit distribution costs, or you can call them selling and distribution costs, and credit accumulated depreciation. So that's going to be 20, which is 2018 depreciation, i.e. 1 year, because you're told it hasn't been charged already. And then you're splitting it 2/5, 2/5, 1/5. So 20 times 2/5 is 8. 20 times 2/5 again is 8. And then 20 times 1/5 is 4. So there's your 20 and it's split across the 3. So just watch the question. Sometimes we get you to allocate it out. That is 40%, which is 2/5. 40% and then 20%. Let's just show the examiner where it's coming from. And remember, you have to track these adjustments as you go then as well. But what we're told at the year end then is the actual recoverable amount is A'20. Now what I don't get into here in IAS36 is I don't ask you the value in use or the fair value less cost to sell. I make it a bit more straightforward. So in that case, you're told your recoverable amount is A'20. So you have an impairment. The impairment here is 120. It's in the book at 940. You can only recover A'20 from it. That means it's impaired. Your asset is valued too high. And your impairment then is going to be split as well. Because all charges, not just depreciating, so watch the wording there, are split between the 3. So we're going to do this again. You're going to get those, put down your adjustment. It's now going to be called accumulated impairment. So it's similar to accumulated depreciation, but actually is a separate item. And you're going to do 120. 2/5 of 120 is 48. 48 and 24. So it's just a nice, now you could have just added those together and do 140 and allocate it out, as long as the examiner can see where they're coming from. But you must split them, if you're told in the question, across each one. So that's an impairment under IAS36 for an individual asset. So your net book value at the 31st of the 12th, 2018 now is A'20. Because you've written down, you've charged depreciation for the year, and at the year end, the property is going to be 820. And we can actually slot that in now, because we're finished with it. Working to property, plant and equipment, A'20. So when you get a chance to slot something in, take it, so you're not doubling back on yourself at the very end. Okay, we've dealt with that. Now we have a couple of adjustments to bring in elsewhere, but we can't do those till the very end. Your next one then, now it depends how far we are in the semester for reading week. This next one is intangible assets and it is prior period errors. So it's IAS38 and IAS8. So we may be looking a bit ahead of ourselves, but all of these will be covered quite quickly in the rest of semester 2. So what we're told in working 3 is IAS8 and IAS38. So we have an intangible asset relating to a license they bought 2 years ago, 1st of January 2017, and they bought it for 100. And they've charged nothing since then. Now, in intangible assets, we don't actually call it depreciation, we call it amortization. Similar concept, just for intangible assets. So they should have really charged amortization, should be amortized of the cost, which is 100 divided by 5. So it should have been 20,000 per annum. That should have been the amortization, and that should have been for all of 2017 plus 2018. So you should have charged 2 years amortization. So what you have here, and this is important, you actually made an error in last year's accounts. And IAS8 deals with this. If you made a prior period error and it was material, i.e. it was significant to the accounts, and you're told that to clarify it here, you must go back and restate last year's accounts. So what you're going to have to do is, you're going to have a prior period error in 2017 under IAS8. Now, we're not going back and doing the P&L for 2017. What you do instead is you debit opening retained earnings 20. And you're going to debit then admin expenses the next 20. So this 20 relates to 2017 expense. This 20 relates to 2018 expense. So that's how you deal with a prior period error. You should have charged 20 last year and 20 this year. But that 20 last year should have been reducing your profits last year, which means your opening retained earnings will reduce. And I will show you how that's reflected in the statement of changes in equity. You will restate your opening balance. Now that's a bit tricky, but we will cover it in IAS 8. So just bear with me and you will see it quite quickly. And then you're going to credit intangible asset accumulated amortization. And that will be the 40, which is the 2 years. So your net book value of intangible assets at the 31st to 12th, 2018 is going to be 100 minus 40. So it should be 60 at the year end. They have it as 100 because they forgot to calculate amortization. So what we're going to do then is we're going to put the 60 in and be finished with it. And we'll deal with retained earnings and admin expenses at the bottom of the question. Right. Sorry, it should go to cost of sales, so not my admin expenses, cost of sales. Just read the question. Okay. So we'll slot that in. And you see, nice and neat, there is presentation marks, working 3, 60. Now again, you may not have the benefit of setting up a full template like that, but when you do it, do non-current assets, leave a couple of lines, fill them in as you go. Same with current assets, fill them in. I just have the benefit of knowing what the solution looks like, so I can have the template ready just to make the screencast a bit clearer. So that's our working 3, nice and labelled. We're now on to working 4, which is the government grant. So we're told we got a government grant for hiring interns for 4 years, but what they've done is they've debited cash and credited the government grant. So we know this is under IAS 20. So you write down IAS 20 government grant. You should be recognised in SOPL over term of grant. So if the grant is for summer internship hires over 20 years, or over 4 years should I say, you should be recognising the income from that grant over the 4 years. So recognise 80 over 4, 20 per annum. That's what you should recognise. The whole idea of the matching principle we talked about. You match the grant income with the expense. The expense is going to be over 4 years, so you match it with it. So what you're going to do, debit cash is fine because you actually got paid it, but you're not going to recognise all of it up front. You're going to leave some of it as a liability, which we kind of call the grant deferred income. So you currently have the full 80 as a credit to government grant. What you're going to do is you're going to debit government grant 20, said reduce that liability, and credit your SOPL to release that, and you're going to credit it to admin expenses. And the reason you're doing admin expenses is you're netting it off against the expense, and you're told here the expense for summer interns are recognised in admin costs. So that's why we're crediting admin expenses. So if they give you guidance like that, you should put it in admin expenses. Otherwise, it could go in other income if you want it. So 20. So your updated government grant figure is going to be 80 minus 20 equals 60. And what you need to be careful with here is that has to be split between non-current liability and current liability. So of that 60, 20 is going to be released in 2019. And then the remaining 40 is going to be released in 2020 plus 2021. So there is the whole idea of you're deferring the recognition of the grant because you have to hire those interns next year and the year after and the year after. So watch when you get a government grant, do I have to split it between current liability and non-current? And for the capital grants, you would. So the current liability is going to be working 4, grant 20, and the non-current liability grant working 4, 40. And again, there will be marks going for that split as well. So 2 years is to be left, and in the most recent year is 2019. What's going to happen next year? So the same entry is going to happen next year. You're going to take another 20 off and release it, or what we call amortize it, to the profit and loss account. So they're nice little workings. I said you pick off the easier ones first and leave the harder ones until the end. So working 5 then is your bad debt. Now this should be a typical AF1 style adjustment. You're told write off bad debts of 6,000. That should be debit admin expenses, credit trade receivables. There shouldn't be too much hassle there. 6 and 6. So debit admin expenses and credit your trade receivables. But you also then have a provision for 10% of remaining receivables. Just double check, have we an opening provision? We don't have any opening provision, so this is creating a provision for the first time. So in our case here, you're going to have a new provision, which is going to be trade receivables currently are 46, and you take off the 6, so you always take off the bad debts before you calculate the provision. So it's 5% of 40, which is 2. Sorry, it's not 5%, it should be, am I reading it right? 10%. So it's going to be 10% of 40, which of course is 4. So what you need to watch there then is you're creating a new provision. That means the old provision was nil, so it's an increase of 4. So it's debit admin expenses, credit bad debt provision, 4. So it's an increase in the provision. You have to watch in other exam questions, you may have an opening provision, and therefore through the P&L you'll only recognise the increase. So always watching your P&L, do I have an opening bad debt provision? In this case we didn't, so the full 4 is recognised. I said some of those you could have done very early on and got your marks before you tackled the harder ones. Working 6 then is your tax. Working 6. Let's have a look here. Tax expense on the trial balance. So we're told here, tax expense is 12 and debit is an expense. But you're told then, usually Tempa has an amount owing, so you'd have a tax liability, but it overpaid the tax authorities due to an admin error and recorded this overpayment in the accounts. So what happened here was they credited a bank because they would have paid money, but then they debited their tax liability. Because when you pay your tax down, you reduce your liability. But if you overpay, it ends up being a net debit. And that's what happened here. They have a debit left in their tax, which means they are actually owed money back. So there's nothing wrong with that based on the notes. They're going to get that money back because they've overpaid. So this actually does no working. It's a current asset. So there's an exam level trick one to see where would you have put that. You can't put it in as a negative liability. It's actually going to be like a prepayment of tax for a future payment for future years. That's just going to reference there. It's going to be a current asset. So there's actually no working 6 there. It's just a tricky one to see what you would do with it. And other ones you may have an over-under payment that has for previous years. This was an overpayment for this year. That's why it's going to be left as an asset. So your working 6 then is actually going to be the interest for note 7. Interest charges of 10% of the outstanding loan have yet to be accrued. So the loan here is 800. So that means you're going to have to charge interest, debit finance costs, credit interest accrual of 80. And that is 800 times 10%. So your finance costs for the year there are going to be 80. And that's coming from working 6. So again, another nice AF1 style question. You could have done that very early and just got your marks and move on. The loan is repayable in full in June 2021. So a good student might say, well, put in that loan liability straight away. That's a non-current liability. So what you're going to put there is 800. And I'll just put there TB as my reference to show there's no working in that. That's just coming from the trial balance, the loan, 800. I generally would not add on the interest accrual to the loan because the interest is probably going to be paid next year. So your interest accrual is most likely going to be working 6, a current liability of 80. Just watch that. I wouldn't really accept putting the loan as 880 because some of that is going to be paid next year. So the interest accrual should go in there working 6. And so you're building up the question as you go along. Now, the last main working I would always advise students to have, and to be honest, as you go through them, you may leave this as your working one, because you'll be able to slot them in as you go along, is what we call your aggregation or your expense table. So you're going to do a working to calculate cost of sales, admin expenses, and distribution costs. Now, as I said, the more questions you do, you'll probably realize I should open up this table at the very start, because I can then slot in the adjustments as I go along, rather than wait until the very end. So just trial and error for a couple of questions till you get a technique. So to do our cost of sales, for example, we look at the trial balance and we take our opening inventory and we take our purchases. So both of them are given in the trial balance. Purchases are 300 and opening inventory is 20. And both of them are adding on to cost of sales. They're increasing the cost of sales. So then what we're looking at is you also have closing inventory, and I referenced there working one. We said the closing inventory was a credit to cost of sales, if you remember, 35. And that's why it's probably a good idea if you can. I'll just tidy this up. It's probably a good idea if you can to have that table open up at the very start, because you could be slotting those in as you go along and not have to go back at the very end like I am. In the trial balance, the starting point for admin expenses, if we look at it here, general admin costs is 40, and the starting point for selling and distribution, I just call it distribution, is 80. Just slot them in, and you can say TB is coming from the trial balance. What you then need to do is you need to go down through each of the workings and figure out, well, what expense goes where. So see, working 2, we're splitting 8, 8 and 4, so we'll slot those in. Working 2, 8 for cost of sales, 8 for admin expenses, and 4 for distribution costs. And likewise in working 2, we had 48, 48, and 24. So that's why it's nice to do it in a neat table. It makes it very clear to the examiner and where the figures are coming from. So that's your 8, 8, and 4, and your 48, 48, and 24. Working 3, we said we're debiting cost of sales 20 for your amortization. And working 4, we're crediting admin expenses 20. So 2 different adjustments there. Working 3, debiting cost of sales 20. Working 4, crediting admin expenses 20. Credit expenses is reducing expenses. So that's the government grant. That is the intangible asset amortization. So there is a good bit of work. This is where marks are coming from as well. So it's nice to have it nice and neat so the examiner can follow. Working 5 then, debit admin expenses 6 and 4. So working 5, 6, working 5, 4. So your bad debt and your movement or creation of a bad debt provision. And then working 6, that's just finance costs. You can do a separate column if you want, or we'll just put it in at the end. Right, but they are your main adjustments. So if you tot them up, then I'll put SOPL. For your cost of sales, you add them up. You're going to get 361. For your admin expenses, just be careful here, you have 40, trial balance. You have 8 and 48. So that should be, not adding them all up, all these as well. So 86. And then you have 108. And they are the 3 ones that you're going to slot into your P&L. And all you do is cross-reference then working 7. So it's nice and neat, it's done here. You're not trying to cram it into the financial statement, and the examiner can see where it comes from. So if you come back to your P&L that might be set up already, you don't have to put in any numbers, just set up like that. Working 7 minus 361. Distribution costs, working 7. Admin expenses, working 7. And that is minus 108 and minus 86 for admin expenses. And just tidy those up to make sure that they're easier to read. And so all of that is nice and straightforward. And it's nice and clean in the P&L, because there will be presentation marks going from that. So I'll leave it at working 7 in a lot of the solutions. It's probably as easy to put it as working 1, and every time you do a subsequent working, you slot them in as you go. So you're taking off a lot of that work that you don't have to come back at the very end and try and do it again and go jump into every working. So once you have that main working done, you're going towards finishing the financial statements. Now this will take a bit of time, but the more you've done as you go through, the less work there is at the end. But you still have to leave a couple of minutes, 5 or 10 minutes of your time, just to actually finish them off. So if there's no adjustment, all I do is write trial balance for revenue, and that's going to be 640. So in that case, your gross profit is 279. We have no other income, so again you can leave it blank, or you can just put 0 in. Just put that as a nice neat one there. I said you might have a template set up that you have all these line items in, or you might slot them in as you go. So you have your distribution cost, admin expenses. We typically don't show anything separate other than leaving them in those 2 buckets. So that's where your working 7, your expense table comes in. And your operating profit then will be those added up, which will get you to 85,000. After operating profit will be finance costs. Just look in your trial balance. We have no finance costs there, but we do have a working 6 finance cost of 80. So working 6 minus 80. That's profit before tax then of 5,000. And your total tax in the trial balance is minus 12. So it's actually not profit after tax, it's a loss after tax. And that will be minus 7. So losses then will be in the brackets. But typically the face of the financial statements are nice and neat, but it's all the work is done in your workings. And that's why I say leave the workings until after you have your pages left for the financial statements. So what I want to see students do is put the first couple of pages will be your actual answer and leave space for that. And then after that you can do all your workings. So you have plenty of space and you're not going to run out of space. So we'll come over then and we'll do our statement of financial position. Now remember, I have the benefit of having the template done. You may just have extra lines, and what you'll be doing is going back to your workings and you'll be going back to trial and say, is there any other long-term assets there? Is there any other current assets? So I have them ready to go just to make it more efficient. You'll just have to spend a bit more time ticking them off as you go. So as you find something, tick it off, bring it in and move on from there. So we have our non-current assets done. It's going to be 880. We have those from before. Your cash, we made no adjustment. So that's coming from the trial balance. Cash there is 330. Your trade receivables, we have workings, just be careful. This is coming from working, if I go back and look, working 5. So you may slot in as you go along. That is going to be, if you just show it here, your 46 minus your bad debt minus your provision. So it's going to be 36. Now for smaller workings, that's fine to put a little bracket there like that to show where it comes from. Other students may just put that working in working 5 and then cross-reference it in to show where they're coming from. And then finally, trial balance tax. You have a prepayment or an asset of 6 for tax. So that was an exam level one that you mightn't have come across before. Just to see what you would do if that came up on the day of the exam. So current assets are 407 and your total assets in this case are 1287. Again, the financial statements are nice and neat and you're using your note column as much as possible. Share capital did not change. Trial balance. Your share capital total here is 50. Now retained earnings you will always have a working for. So your starting point is 232, the opening retained earnings. You take off, number 1, your loss for the year of 7. That comes from the SOPL. You take off 20 because that's a prior period error. Remember here we had it up. Debit opening retained earnings from working 3. Because what we're saying is that 232 should have been 20 lower and I'll call that a IAS 8 adjustment, your prior period error. Because if profits in 2017 were 20 lower, my retained earnings, the 232, would have been 20 lower as well. So what we call that is a retrospective adjustment. And you'll see that when we cover IAS 8. And of course, you take off the 10, which is the dividends. Don't forget to look at the trial balance to see if there's any dividends. So it's 232 minus 7 minus 20 minus 10. So your total equity is 245 for the year. So that was tricky, but you'll always have a working for retained earnings, and there will always be a good few marks going for it. So have that in the back of your head. So non-current liabilities were finished. That is 840. And then our current liabilities, we have 2 of them done. The only other one we're left with, which we had no adjustment, is the trial balance. And you said your trade payables there are 102. So your total current liabilities will be 202. Now I said I had the benefit there of having a pre-populated template. You won't. So it'll take you a small bit longer to go back to your working, tick off the workings as you find them, and also to go back to your trial balance and just double check every so often, have I all the expenses in? Have I all the assets in? Have I all the liabilities? So it'll just take a small bit longer to complete the question. So that then hopefully means our total liabilities plus equity will equal 1287 as well, and thankfully it does. Now if it doesn't, and it often won't in the exam, just spend a couple of minutes looking to see if you've ticked off everything, but after that you have to move on, because you're not, oftentimes it can be a little typo or a small error, and you'll get a lot more marks for moving on to another question than trying to perfect this particular question. So by all means do look for any obvious errors, but after that be careful of your time and do move on. So the last statement you're going to do then is we're going to take this equity section, which is only 2 items here, so it's a relatively shorter one, and we're going to see, can we do the statement of changes in equity? This is the one that's commonly asked, so you do need to know it. And your template is going to look like this. 50 ordinary share capital, and you have 195 retained earnings. Now I said, I usually leave this till the end. Some students will use the statement of changes in equity to do the working for retained earnings, to actually get back to here. That's fine. So whichever way you want to use it, as long as you have the same layout, you'll get full marks. So I often say do your 2 statements, the P&L and the balance sheet, and then finish off your statement of changes in equity. So in our case here, we're working back to say, well, what moved this retained earnings? Well, the first thing that moved it was the loss for the year. And we know that would have been -7 to the retained earnings column. And we also had dividends, and we'd flagged that already. That would have been -10. So both of those would have been in there. So that would have meant, if you think about it, if we had those 2 adjustments, my retained earnings balance here should have been something -17 gets me 195. So if you add back 17, it should have been 212. Now, what we have to know, we actually know the balance at the start of the year was 232. So go back and look at your balance sheet. We said the opening balance was 232 at the end of the year, which would have been the opening balance for this year. But we're saying our balance here is 212, and that's where this difference of -20 comes from. And now this is going to IAS 8 that we're going to cover in a lot more detail during semester 2. This is what we call the prior period error, and that's how it's shown up. So what you're going to do there is you're going to do restated opening balance. First is the first 18. So that's what IAS 8 tells you to do. It says when you have a prior period error, you must restate the accounts. So that means if you had charged intangible asset amortization in 2017, your profits would have been 20 lower, which means your retained earnings would have been 20 lower as well. So you should have been starting at 212, and then you do your normal adjustments as you would for any statement of change in equity. So there will be marks going for that to make sure you put it in like that as a separate piece, and you restate the opening balance. So make sure you go back to your IAS 8 notes, and we cover that in a lot of detail, how you deal with prior period errors. There's been no change of share capital, so opening balance was 50 and the restated opening balance was 50 as well. So that means closing here would have been 262, or opening should I say, and here 282. Right, so again, that's what we're looking for in terms of statement of change in equity. Often a very easy one to get marks on because you're not doing any extra adjustments. The only complications you can have is dividends, the profit or loss for the year, the prior period error under IAS 8, and the only other one to watch for is when you have a revaluation reserve. So that means you will have a reval reserve column and you will have other comprehensive income here. But you will see that in some other past exam questions as we go through. Right. So that gives you a good idea of the standard of a question 1 to expect in AC220. Right. And what the key takeaways are, the first thing, read what is asked. How many statements are you asked? What time is allocated to those statements? And then work back, have a look over all of the question, mark it up, and then be neat in your workings and be neat in your financial statements. You have roughly in and around 1 hour to do the question, depending on how many marks there are, but this will all be about practice. If you don't know your standards and you haven't practiced these style questions from laying them out and under time pressure, you can do poorly in the exam. So it's about practicing. There's plenty of past exam questions to go through, and we'll do them for some tutorials as well. Right, so that looked at autumn 2019, question 1, Tempa Limited.